start with the foundation. A disability policy is priced on the probability you become disabled, the likelihood the claim lasts a long time, and the expected total benefits paid. Your base premium reflects age, health, occupation class, income and benefit amount, elimination period, benefit period, definition of disability, and any policy features already built in. Riders add extra ways the policy can pay, and the more the policy can pay, and the longer it can pay, the higher the premium tends to be. Think of rider costs in two buckets. Bucket 1 increases benefit size during claim, especially on long claims. Bucket 2 increases the chance of payment by paying under more claim situations. COLA primarily affects Bucket 1. Residual primarily affects Bucket 2, and future increase is different. It is mostly an option to expand coverage later. Now let us define the riders in plain terms. COLA, cost of living adjustment. This rider increases your monthly benefit while you are on claim. Many versions apply after a waiting period on claim, such as after 12 months of disability, then adjust annually. Some are tied to an inflation index, some use a fixed percentage like 3%, some have caps, some compound, some simple. The higher the cap, and the more generous the formula, the more powerful the rider. Residual, also called partial disability. This rider pays a partial benefit when you are not totally disabled but your income drops due to sickness or injury. Many policies require a certain percentage income loss, such as 15% or 20%, and then pay proportionally. Some versions include recovery benefits, where you may still receive partial payments even after you return to work while your income rebuilds. Future increase, also called future purchase option, benefit update option, or guarantee insurability. This rider gives you the right to increase your benefit later without new medical underwriting, typically at certain ages, or at certain intervals, or after income increases. You pay a small cost now for that right, and when you exercise the option you pay the new premium for the added benefit based on your age at that time. Now the core question, which raises premiums most. Most of the time the ranking is COLA highest, residual middle, future increase lowest upfront. That is the most common pattern in standard quote sets. The reason is simple. COLA can dramatically increase total dollars paid on a long claim, especially with longer benefit periods. Residual increases the number of payable claims because many real disabilities are partial, not total. Future increase usually does not increase today benefit amounts. It increases the future flexibility, so the insurer charges less upfront. Let us go one by one and connect benefit value to pricing logic. COLA and premium impact. A base disability benefit is a fixed monthly number. If you become disabled at 35 and remain disabled for many years, inflation can cut the buying power of that fixed number by a lot. COLA exists to protect your purchasing power, but protecting purchasing power can be expensive for insurers because long claims are already the most costly claims. COLA makes those expensive claims more expensive. The longer your benefit period, the more COLA matters. If you have a benefit to age 65 or longer, COLA can add a large amount to total claim costs. If you have a shorter benefit period, the COLA impact drops. A quick example. Imagine a $5,000 monthly benefit. With the 3% compound COLA, by year 10 of claim the monthly benefit is roughly $6,700. By year 20, it is roughly $9,000. That is a huge change in total dollars paid. Even with caps, the insurer is taking on a bigger long-tail risk. That is why COLA often carries the highest premium increase among common riders. Residual and premium impact. Residual is often the rider people say they cannot live without once they understand it. Many disabilities do not stop work completely, they reduce capacity, reduce hours, or force a lower paying role. Without residual coverage, you might not qualify for benefits unless you are totally disabled. Residual turns many near-miss situations into payable events. From a pricing view, that increases claim frequency. Higher frequency means higher expected payout, even if the monthly payout is smaller than total disability. Residual also often includes recovery benefits, which can extend payments during the income rebuilding phase. That extension can increase claim duration, another key pricing driver. An example: you are a dentist, injury limits procedures, you cut workload, income drops 30%. With residual, you may receive a partial benefit, perhaps around 30% of the monthly benefit, depending on the policy formula. Without residual, you might receive nothing. Multiply that effect across a population, and the insurer sees more paid claims, so premiums rise. Still, residual is usually less expensive than COLA because it does not automatically increase the benefit year after year on the largest long claims. It expands payment eligibility. Future increase and premium impact. Future increase is mostly about insurability and growth. You may be healthy now, but later you might develop a medical issue that makes buying more disability insurance difficult or impossible. The rider lets you increase the benefit without new medical underwriting. The cost today is usually modest because you are not getting more benefit today. You are buying an option. When you exercise it, you pay the added premium at your then print age. So the rider cost is typically a smaller surcharge now, with the larger premium increase happening later only if you use it. An example: you start with a $4,000 monthly benefit early per-year. In a few years, your income grows and you increase to $8,000 under the option. The future increase rider itself might have been a relatively small add-on to your original premium, but the additional $4,000 you buy later will increase the premium significantly. That increase is not from the rider cost alone, it is from buying more insurance. So if you are comparing riders on a quote today, COLA usually raises premiums the most, residual is commonly second, future increase is commonly third. Now let us cover when the ranking can change, because real-world quotes are not always uniform. Exception 1. Very strong residual design. Some carriers have richer residual definitions, lower income loss thresholds, and strong recovery benefits. If residual triggers easily and pays longer, it can cost more. For some occupations where partial disability is more likely, residual can be very close to COLA in premium impact, and in rare cases it can exceed a mild COLA option. Exception 2. Weak COLA versus strong residual. Not all COLA riders are equal. A simple COLA with low caps might not add as much as a rich residual with recovery. If you compare a minimal COLA to a top-tier residual, residual could appear more expensive. But when COLA is robust, such as 3% compound or